Good morning everyone, Clifford Bennett, Chief Economist, ACY Securities. What big moves? Well, relative to some recent price actions, we had quite a big down move in the US dollar, and that was really triggered by the ECB raising interest rates by 25 points. The market acted as if that was a surprise, but it's hardly a surprise. The ECB's been very clear about it's going to continue to raise interest rates for quite some time, fighting inflation. Which begs the question, how does that work when Germany is already in recession? Several European countries have negative growth. It's difficult to see how that's going to end well. So basically what we're going to have is Europe in recession yet again. So that begs again another question: why is the German stock market at all-time highs when the economy is in recession? There's high inflation and the ECB is raising interest rates. The world has definitely changed, and it doesn't play by the old rules. And of course it has to do with lots of excess government spending. It has to do with the AI surge, and also of course to do with weapons manufacture and that sort of thing, unfortunately. How long can it last that a stock market keeps going up to record highs when the underlying German economy is in recession and the ECB is making sure that all of Europe will go back into recession? So we have still in the Western economies a very simplistic central bank approach to things. Whereas elsewhere around the world there's been far more nuanced responses. In the Western central banks we still see, particularly in the ECB, the Fed, the RBA, Canada as well, we see this focus on inflation. New Zealand, I'll never forget when the New Zealand governor of the central bank there, he was speaking at a conference over in Europe not so long ago, saying that he had done the job. Very proud of the Reserve Bank of New Zealand. We've done the job. Inflation is beaten. We won't need to raise rates again. That was about a year ago. What have they been doing since? So they haven't quite, this Western economic approach intellectual approach hasn't quite picked up what's really going on in the real economy, in this modern economy that's very dysfunctional post the COVID interruption. It wasn't the COVID virus, it was the lockdowns, the shutdowns, the interruption to trade, the interruption to travel, the interruption really to communications and just normal life that has created an excessive government response of too much stimulus around the world. And I felt so in real time. And the Western central banks keeping interest rates near zero or at crisis record low levels for far too long. I mean, everyone could see there was no more crisis during the recovery, and yet interest rates were still at crisis levels. Now, as the German economy is in recession and several European economies have negative growth, now the ECB wants to be raising rates. It cannot end well. That's all I can say. It cannot end well for Europe. It cannot really turn out that well for the United States either. So where the United States is headed at the moment, as I've said, is a very real risk of recession. After that, it's not going to be an immediate economic rebound. And I think this is one of the things people aren't really comprehending at this moment, particularly in Wall Street, in their ivory towers. And that is that this economic slowdown that is really entrenched now, with high inflation, with central banks raising interest rates, means that this could be a 1, 2, or even 3-year sluggish economic growth period, severe underperformance, perhaps recessions in Europe and the United States and Australia. These are not typically historically great environments for buying stocks, yet still they continue to rally. I did say yesterday that the US stock market will often rally the day after there is good news on interest rates, and that's what we saw in New York trading. It may not be sustained in this Friday trading or early next week. So I'm still risk off on the equity market because I still see that stretch between the fundamental economic reality on the ground and what's happening in the equity market as something rather odd. The justifications for it are that yes, AI is going to have a huge impact. AI companies who are on the ground and already sophisticated in AI and the provision of services to other companies and consumers of AI products are definitely going to be, a big boom market. There is no doubt about that. There is no doubt there's a lot of share buybacks going on, and there is no doubt that the excessive spending, particularly by the US government, just, it went up 25-30% for COVID and it's still going up. So, what government spending used to occur in the US economy, it's still 30% to 35% more than it was. So that excess liquidity eventually finds its way to people who need to put that money somewhere. And that is, of course, in the US equity market. The US data yesterday was relatively unimpressive. People got excited about retail sales being up 0.3%, but over the last couple of months they were down 0.2%, and over the last 3 months, they were down 0.2%, and over the last 4 months they were down around 0.7% or 0.9%. So the retail, like all of the economic data at the moment, be very careful of any single month because the data collection seems to be more volatile than it used to be. We're definitely seeing that in for instance, the Australian employment data that was out yesterday. And I think you've really more than ever got to look at those 2 to 3 month trends in the economic data. In the US yesterday, we had manufacturing output was up, but really 0.1% flatlining. Industrial output production fell. So that manufacturing recession continues in the United States. So retail sales and industrial output both flatlining really. And the Fed likely to keep hiking interest rates. And the only thing that will stop the Fed from raising interest rates another 2 to 3 times this year to fight inflation, because I do not think core inflation or services inflation is going to be contained. So the only thing that's going to stop the Fed from hiking another 2 to 3 times this year will be a resurgence of the banking crisis. So we don't want that to happen, but that remains a very real risk and something to not think is gone away. It's out of the financial media headlines, but it's a very real process that continues as more and more businesses realize if they're going to secure their future, they need to have their deposits with banks that have a full government guarantee, not a limited one. So that drain on regional banks will be continuing. Inflation will stay firm to high. And you've got to remember, while the headline inflation rate has virtually halved from its peak, it's still too high. But more worrying than that is that the core inflation number hasn't come off its peak very much at all. It's consolidating near its peak. And that is the concern for the Fed. That's why there's going to be a continued tightening bias and perhaps, and almost certainly, further rate hikes this year. In the midst of all of this, the equity market continues to rally. I guess you have to watch the price action. There's no doubt the price action is bullish, and there's no doubt the fundamentals are dire. So keep an eye on that price action. If it ever gives you an indication that the equity market could be beginning to fall back in on itself, which could happen as early as later today or into next week, do not be slow to protect your stock holdings. Plenty of financial instruments available these days to do that, and we should all be ready and think ahead with a strategy to play defense should there be a downturn. For the moment, the euphoria over AI, the share buybacks, those things are supporting markets. But if sentiment turns on this AI euphoria, so if the AI euphoria runs its course, then equity markets are going to be badly exposed to the potential for again another shift lower. Lots to think about, but I think basically the underlying scenario in a nutshell is what I just said, that the price action may be bullish, but the fundamentals are dire and likely to deteriorate further, particularly in Europe. People might be surprised by how quickly the European economy begins to slow again. Thanks very much. All the best. Clifford Bennett.